Welcome to Griffonomics. Today we're diving into equipment share, trading under the ticker EQPT. But before we get into the financial mechanics, I want you to picture something.
Yeah, setting the scene is crucial here.
Right. So imagine a single construction site with like a $10 billion budget. It's a hyperscale data center covering, 500 acres of dirt.
Massive scale.
Exactly. Now, picture 4,000 pieces of heavy machinery excavators, scissor lifts, bulldozers, generators just swarming that lot 24 hours a day. If you are the general contractor, how do you track which subcontractor has the keys to which forklift?
You don't. I mean, historically, you just couldn't.
Right. How do you know if a generator on the north side of the campus is, running out of diesel before it shuts down the power grid for an entire concrete pour? In the old analog world, you'd use whiteboards, spreadsheets, and walkie-talkies. And you would inevitably bleed millions of dollars in lost time.
It is absolute chaos without a digital nervous system. And that is exactly why we have this massive stack of sources today. We are looking at earnings reports, investor presentations, transcripts from the 16th Annual Wells Fargo Industrials Conference, and a forensic audit of EquipmentShare's second quarter 2026 earnings call.
Yeah, and the mission for this deep dive is to figure out exactly what this company is. Because if you just drive by one of their lots, you see yellow iron, right?
Yeah.
You might assume they are just a traditional brick-and-mortar equipment rental yard.
Which is exactly what a lot of traditional investors thought.
Exactly. But when you lift the hood on these documents, there's this fascinating corporate story that sits at the intersection of heavy machinery, cutting-edge enterprise software, and honestly, highly complex financial engineering. So whether you are an investor trying to understand why this stock has been on such a wild ride, or you are just fascinated by how digital technology rewires old-school analog industries, we're going to completely reframe how you look at a construction site today.
Yeah, the visual tension here is what makes this so compelling. Imagine my backdrop right now as a split screen.
Okay, I'm picturing it.
Right. So on one side, you have high-rise blueprints, muddy boots, and, heavy diesel engines. On the other side, you have blinking digital server racks, cloud computing architecture, and clean lines of code.
Wow.
EquipmentShare is essentially taking one of the most physically intensive fragmented industries on Earth and overlaying it with a centralized digital ecosystem.
I love that visual. But to understand where they're going, we first have to unpack the absolute roller coaster this stock has been on since they went public. Let's rewind to early 2026.
Right, the IPO.
Yeah. The company IPOs, the stock opens near $32.50 a share. The hype is massive. And then it enters this prolonged, just painful slide. The stock bleeds out, dropping all the way down into the $18 to $20 range over a matter of months.
Yeah, that is a massive chunk of enterprise value just wiped out.
Completely. And the sources point to a perfect storm of downward pressures. But the biggest red flag for Wall Street seemed to be their cash burn, right?
Exactly. And you have to look at this through the lens of a traditional industrial investor. In just the first 6 months of 2026, EquipmentShare generated a negative $142 million in net operating cash outflow.
Man.
But the real shocker was the investing outflow. They spent a staggering negative $730 million. They were buying gross fleet actual physical machines to the tune of over $1 billion.
Okay, wait, stop right there. If I am a portfolio manager accustomed to looking at mature cash-generative peers in this space, like, United Rentals or Sunbelt, and I see a newly public company incinerating over $800 million in combined cash outflow in 6 months, I am hitting the sell button.
Oh, without a doubt.
That looks less like a business and more like a bonfire.
And that is exactly what the market did. Traditional investors punished the stock because it looked like, high capital intensity with zero discipline. But that cash burn was really just the first domino. The second major pressure came from widespread confusion over how EquipmentShare actually pays for all those bulldozers. This introduces their off-balance sheet OWM program.
Right, the owner-worker network. And we're going to dissect the financial engineering of this later because it's brilliant, but mechanically, this is a structure where third parties purchase the equipment and EquipmentShare manages and rents it out. How did this cause the stock to tank, though?
Well, it caused confusion on the income statement. Because EquipmentShare pays a portion of the rental revenue back to those third-party owners, those payouts are recorded as direct operating costs.
Oh, I see.
Yeah, so this aggressively mutes their GAAP net income. So for the second quarter of 2026, EquipmentShare reported just $19 million in GAAP net income, but their adjusted core EBITDA, which adds back a lot of these non-cash and structural items, was $531 million.
That is a chasm. $19 million on the bottom line versus $500 million in adjusted earnings. I mean, I can see why analysts would look at that and think management is playing accounting games.
Absolutely.
When there is that much daylight between GAAP net income and adjusted EBITDA, Wall Street immediately questions the true underlying cash conversion of the business. They just assume you are hiding bad unit economics behind adjusted metrics.
Precisely. And, just as investors were questioning the accounting, the lawyers started circling.
Oh, right. The lawsuits.
Yeah. The third major driver of the stock slide was governance headlines. In mid-2026, multiple class action shareholder lawsuits were filed by firms like Faruqi and Robbins LLP. The core allegation was that the pre-IPO disclosures lacked transparency regarding related party arrangements. Specifically, the founders were leasing their own privately held real estate back to the public company.
Yeah, that is a classic red flag. I mean, whenever you have founders acting as the landlord to the publicly traded company they run, institutional investors get very skittish.
Very quickly.
It raises immediate conflict of interest questions, like, were they overcharging the company on rent to line their own pockets? Even if it's entirely above board, the optics are terrible for a newly public entity. The sources show those lawsuits triggered sudden single-day stock declines of 6 to 11% in late June.
It completely shattered the post-IPO momentum. So, you have a massive cash burn narrative, you have accounting confusion, you have related party lawsuits, and then right in the middle of this crisis of confidence, management decides to drop a mountain of debt onto the capital structure.
Right, the bond issuance overhang.
Yes. In June 2026, EquipmentShare launched a private offering of senior secured notes due in 2034. It started as a $1.05 billion offering and was subsequently upsized to $1.35 billion at a 7.125% fixed coupon.
Wait, taking on $1.35 billion in debt at over 7% interest? That's nearly $100 million a year in pure interest expense.
Like, exactly.
If your stock is already bleeding because people think you're burning too much cash, locking in $100 million in annual interest payments seems like throwing gasoline on the fire.
From a short-term perspective, it absolutely looked that way. Combine this new interest expense concern with a broader macroeconomic trend called multiple compression, where Wall Street was just trimming valuation multiples across the entire industrial machinery sector out of fear of a recession, and you get a stock that crashes from $32.50 to $18.
Wow. So it was basically priced for disaster.
Mm-hmm.
But then August 12, 2026 arrives. They release their second quarter earnings, and the narrative violently snaps in the other direction. The stock triggers an 11% after-hours rally. So let's audit this Q2 report, because the numbers here are staggering.
You really are.
The headline is a massive revenue beat. They hit $1.449 billion in total revenue for the quarter. That is a 26.3% surge year over year. They beat Wall Street consensus expectations by $304 million. I mean, you don't accidentally beat estimates by $1/3 billion.
Okay. No, you don't. It is a phenomenal top-line acceleration. If we isolate just the equipment rental and services operations segment, which is the core fundamental driver of the business, that specific revenue stream surged 39.5% year over year to $908 million.
Okay, top-line growth is great, but if they bought that market share by slashing rental rates or, over-leveraging, it's a house of cards.
Yeah.
How much of that $1.4 billion actually flowed down to the profitability metrics?
That is where the quarter proved the skeptics wrong. Adjusted net income came in at $43 million. That translates to 18 cents in adjusted earnings per share, which beat Wall Street estimates by a massive 22 cents per share.
Oh, wow.
Yeah. And that adjusted core EBITDA number we talked about, it reached $531 million.
Okay, let's unpack this. How can a company blow past revenue expectations by $300 million, generate over $500 million in adjusted core EBITDA, while simultaneously burning $142 million in operating cash just months prior? How do these two financial realities exist inside the exact same corporate entity?
They exist because analysts were applying the wrong framework. Traditional equity analysts were treating EquipmentShare like a legacy, mature industrial business. In a mature business, heavy capital expenditure means you are inefficiently maintaining your existing market share.
Right.
But EquipmentShare isn't a mature industrial. It is a hyper-growth, digitally native compounder. That tension you are pointing out comes down to how you account for the cost of conquering new territory.
Ah, so you're talking about the startup costs for new locations dragging down the current earnings.
Exactly. Adjusted core EBITDA adds back things like the $60 million in new market startup costs incurred during the period. It measures the cash-generating power of their underlying established operations before you subtract the massive investments they are making to aggressively open new branches.
I see.
Wall Street was looking at the GAAP bottom line and seeing a struggling rental yard. Management was looking at the adjusted core EBITDA and seeing a highly profitable tech platform successfully grabbing market share at breakneck speed.
Okay, I understand the theory of adding back startup costs to see the core business. But if I am an investor, you cannot pay me dividends with adjusted metrics. You cannot buy back stock with adjusted metrics. Real cash is still flying out the door to the tune of $1 billion in fleet purchases. Why are they spending so aggressively right now?
Because the cash burn is entirely by design, and it is the necessary fuel for their unique organic expansion strategy. They aren't burning cash to keep the lights on. They are intentionally front-loading capital to plant flags in new geographic markets as fast as humanly possible.
Okay.
And that leads us perfectly into the mechanics of their site-level unit economics, or what the industry refers to as the J-curve.
Yes. I want to spend some real time on this J-curve concept, because when you actually map it out, it explains the hidden value in the entire company. Let's break down the anatomy of opening a brand new equipment share location, what they call a greenfield branch. We have the exact transcript from the Wells Fargo Industrials Conference where their chief data officer, Mark Wopada, laid out the math for analysts. What actually happens mechanically and financially on day one of a new branch?
On day one, and really for the first 12 months, it is an incredibly painful financial exercise. Opening a new greenfield branch requires an upfront cash burn of approximately $2.5 million. And you have to understand where that money is going. It goes into initial overstaffing and overfleeting.
Right, because you are signing a commercial lease on a massive dirt lot. You have to pour concrete for a maintenance shop.
Yeah.
You have to hire elite diesel mechanics, outside sales representatives, and Class A truck drivers. And you have to put them on payroll before a single customer has even signed a contract.
Exactly. And more importantly, you have to fill that massive yard with millions of dollars of brand new yellow iron. You cannot open a rental bitch with empty shelves. If a general contractor calls and needs 4 aerial boom lifts tomorrow at 6 a.m., and you tell them you have to order them from the manufacturer, they will hang up and call United Rentals.
Yeah, they're not going to wait around.
Exactly. So Equipment Share intentionally operates at a steep loss for the first year to build immediate, overwhelming local scale.
It reminds me of planting an apple orchard. For the first 2 years, you are leasing the land, you are buying tons of fertilizer, you are paying workers to prune branches, and you are getting absolutely zero apples. You are hemorrhaging cash.
Yep.
But you aren't doing it because you are bad at business. You are doing it because you understand the biology of the tree. You know that if you endure the early burn, the yield on the back end is massive.
That is a phenomenal analogy because the biology of an Equipment Share branch hits a massive inflection point in year 2. During the second 12 months of operation, the local market absorbs the fleet. The sales reps have built their books of business, the equipment is out on job sites generating daily rental rates, and the branch EBITDA margins rapidly scale up to 40%.
Wow, that fast.
Yeah. But the real structural magic happens once a site passes month 24.
Month 24 is the magic threshold.
Yes. At that point, it officially becomes a mature location in their accounting metrics. The heavy lifting of the startup phase is completely done. The fixed costs of the facility are fully absorbed by the high volume of rental contracts, and those mature sites hit a staggering 55% adjusted EBITDA margin.
Unbelievable.
Furthermore, they generate a 16.5% return on invested capital, or ROI.
A 55% EBITDA margin on a heavy equipment rental yard. I mean, that is software-level margin on physical steel. And this is exactly where the hidden value in the stock lies. Because if we audit their entire network, the sources show they have 430 total locations. But if we isolate the 391 full-service rental branches, they are split into 2 very distinct, very important cohorts.
Right. Out of those 391 full-service branches, 219 are classified as mature locations. They were over 24 months old, the orchard is fully grown, and they are printing money at that 55% margin. However, 172 of those branches are classified as growth locations.
Meaning they're under 24 months old.
Exactly. They are currently dragging through that painful, cash-burning trough of the J-curve.
So if you are a short-sighted Wall Street analyst who only looks at top-level consolidated numbers, you look at the drag from those 172 growth branches, and you can conclude, wow, Equipment Share is highly inefficient, their margins are structurally lower than their peers. You're basically penalizing them for planting the orchard.
Exactly. But if you understand the J-curve model, you realize that those 172 branches represent a massive coiled spring of future cash flow. Over the next 12 to 24 months, as those branches age past the 2-year mark, they are going to mathematically transition from 40% margins up to 55% margins. Management calculates that this simple maturation process will automatically unlock over $150 million in incremental annual EBITDA.
And the most crucial point for you, listener, to grasp here is that they get that $150 million EBITDA bump purely from their existing footprint. They don't have to go out and acquire a competitor. It requires zero additional capital for mergers and acquisitions.
That organic growth engine is a huge differentiator. Let's contrast EquipmentShare's 100% organic greenfield playbook with how the legacy incumbents operate. You have United Rentals, which is the massive gorilla in the space trading under URI with about 1,400 branches, and you have Sunbelt Rentals with about 1,280 branches. How did they get so big?
Well, they bought their way there. United Rentals is famous for its M&A consolidation strategy. They spend billions acquiring large regional competitors, companies like Ahern Rentals or Blue Line. They grow by writing massive checks to buy out existing yards.
Right. But the structural problem with the M&A strategy is the baggage you inherit. When you buy a regional competitor, you inherit massive location overlap. You might suddenly own 3 yards in the same zip code, forcing you to consolidate.
Ouch.
Yeah, and you inherit older, heavily depreciated equipment that might not fit your maintenance protocols. And critically, you inherit outdated industrial outdoor storage properties that were chosen 20 years ago by a local founder, not optimized for a modern logistics network.
Whereas EquipmentShare is starting with a blank canvas. The sources mention they use a real-time search algorithm across all U.S. metropolitan statistical areas to custom select the absolute optimal piece of dirt based on highway access, population growth, and future construction permits.
Exactly. Because they handpick these optimal logistical hubs, they can achieve much higher fleet density per yard. What's fascinating here is a point Mark Wapata made at the Wells Fargo conference. He said there is no magic number for fleet size at a branch. An average mature site for a traditional legacy peer might hold $10 million to $15 million in original equipment cost, or OEC.
Meaning the total purchase price of all the machines sitting on that lot?
Correct. But EquipmentShare sites vary widely depending on the density of the metropolitan area they're serving. A branch might hold $20 million in OEC, or it might be scaled all the way up to $70 million in metal.
Wow.
But the incredible part of the unit economics is that regardless of whether a yard holds $20 million or $70 million in equipment, that mid-50s EBITDA margin and high teens ROIC holds true. It proves that their organic model is infinitely scalable without losing efficiency.
Okay, I have to step in and push back on this on behalf of the listener. Opening 172 new branches and dropping $70 million of equipment on a dirt lot sounds incredibly impressive on a financial spreadsheet. But how does EquipmentShare guarantee that these new branches will actually get customers?
It's a fair question.
Right. What prevents them from signing a 10-year lease, suffering that $2.5 million startup burn, and then just watching the equipment rust? Because United Rentals and Sunbelt already have decade-long relationships with every local contractor in that town.
That is the million-dollar question for any greenfield expansion. And the answer reveals the brilliance of their go-to-market strategy. EquipmentShare isn't opening yards on speculation and just hoping local plumbers and roofers show up. They are playing a completely different game. They are following their existing enterprise customers to the biggest job sites on Earth.
What do you mean by following them?
The data shows that over 75% of the first-year rental revenue at newly opened EquipmentShare locations is pulled directly by existing regional and national account relationships.
Wait, are you saying that 75% of the revenue for a brand new branch is practically locked in before they even cut the ribbon?
Effectively, yes. More than 90% of the engineering news record top 50 general contractors, the massive firms that build skyscrapers and stadiums, already rent with EquipmentShare, and these massive national accounts have greater than 95% annual retention rates with EQPT.
That's insane loyalty.
It is. So imagine a giant contractor based in Texas wins a massive bid to build a factory in Ohio, a state where EquipmentShare historically had a smaller presence. That contractor essentially calls EquipmentShare and says, "We just won a $2 billion job in Columbus. We need you there because we refuse to run our job site without your technology." EquipmentShare then opens a greenfield branch in Columbus to service guaranteed demand.
That completely de-risks the J-curve. They aren't hunting for new market share. They are just fulfilling the backlog of their most loyal clients, which pivots us perfectly into the macro environment driving this demand. the mega project boom. The numbers in these sources regarding construction spend are almost hard to fathom. We are looking at a U.S. non-residential construction market that has over $7 trillion in public and private capital projects breaking ground over the next 5 years.
It is a secular supercycle driven by a confluence of trends: the onshoring of manufacturing, the transition to green energy, and the AI revolution. We are talking about multi-billion-dollar hyperscale data centers, massive semiconductor fabrication plants, EV battery manufacturing facilities, and sprawling healthcare campuses.
Huge footprint stuff.
Exactly. Equipment Share classifies a mega project as any site with a capital spend of $300 million or more. And currently, Equipment Share is actively renting equipment to 80% of the active and planned mega projects within their serviceable footprint.
Let me repeat that because it's staggering. 80% market penetration on the most lucrative, largest projects in the country. And the logistics of how they service these mega projects is wild. They don't just drive a flatbed truck over and drop off a bulldozer. For a $10 billion hyperscale data center, Equipment Share is physically setting up dedicated 5-acre operating yards directly on the job site.
Yep. They're essentially embedding themselves.
Right. They're acting as the sole source equipment prime. They manage the tooling, the fueling, and the temporary site power for the entire project.
The sheer scale of these projects is the ultimate competitive moat. A mega project doesn't just need a few scissor lifts. It requires 3,000 to 4,000 machines operating simultaneously 24 hours a day. And the critical bottleneck is that a contractor often needs that entire massive fleet mobilized within an incredibly narrow 6 to 8 week window to stay on the construction schedule.
That's a logistical nightmare.
It is. According to management's commentary, Equipment Share is one of only 4 rental companies in the entire world capable of fleeting 3,000 to 4,000 machines to a single job site in that time frame.
Just to quantify that volume, the Q2 deck notes that in the second quarter of 2026 alone, Equipment Share placed over $750 million of brand new fleet on rent for the very first time, primarily to feed these mega projects. That is $750 million of heavy metal moving across the country in 90 days.
It's massive.
But let me challenge this thesis. If United Rentals and Sunbelt are also in that exclusive club of 4 companies globally who have the balance sheet to handle this sheer volume, how is Equipment Share actually winning these bids as the sole source provider? Why would a multi-billion-dollar contractor choose the younger disruptor over the established 50-year-old legacy giants?
It comes down to a concept Marco Pata called the nonlinear complexity curve.
Break that down for me.
Think about the legacy rental model. Managing $1 billion of construction spend across 50 different warehouse projects in 50 different cities is relatively straightforward for a legacy rental company. You dispatch a few machines here, a few machines there, but managing a single $10 billion data center where you have 4,000 machines swarming a massive 500-acre footprint with thousands of different subcontractors swapping shifts 24 hours a day, that level of density fundamentally breaks legacy analog tracking.
Because if you're using whiteboards and phone calls to track which electrician has the keys to the only 150-foot boom lift on site, the project devolves into chaos.
Exactly. Millions of dollars in labor are lost simply because highly paid union workers spend 3 hours walking a 500-acre site looking for a specific machine only to find the battery is dead. Equipment Share wins these sole source contracts because they aren't just dropping off dumb metal, they are installing a digital brain on the job site.
And this is where the story shifts from talking about dirt, diesel, and J-curves to talking about software, silicon, and the true competitive moat. Let's do a strict audit of the T3 technology ecosystem because this is the engine driving everything we've talked about so far. T3 is Equipment Share's proprietary cloud-connected operating system, and critically, it is embedded natively across 100% of their managed fleet.
It is a massive technological differentiator. Every single piece of Equipment Share machinery comes natively equipped with T3 hardware. We are talking about IoT access keypads wired into the ignition, 2-way dash cams for safety and liability, and advanced telematics trackers. This system is actively ingesting 6.4 billion data points every single day across an ecosystem of 250,000 machines.
6.4 billion data points a day. What are they actually tracking?
Everything. Real-time GPS location, hydraulic pressure, engine temperature, idle times versus active burn times, fuel levels, and operator behavior.
But I have to play the skeptic again here. I know for a fact that the legacy guys, United Rentals and Sunbelt, have GPS trackers on their gear too. It's 2026. Telematics isn't exactly a secret weapon anymore. What makes T3 functionally different from what the incumbents offer?
The difference is the chasm between passive tracking and active control. The legacy telematics layers used by the incumbents are generally third-party, bolt-on, passive GPS systems. They give the contractor dots on a map. They can tell you where a machine was parked yesterday and maybe how many hours the engine ran. That is passive data. T3, on the other hand, is an active operating system wired directly into the machine's control area network.
Give me a tangible example of active control. How does that actually save a contractor money?
Because of the smart keypads wired into the ignition, T3 allows for event-based digital access control. Let's say you have a massive crane on site. The general contractor can use the T3 software to mandate that only operators with a specific safety certification can turn the machine on.
Oh.
Right. If an operator's certification expired last Tuesday and they punch their PIN code into the keypad, T3 actively disables the ignition. It prevents unauthorized use, it drastically reduces liability and theft, and it prevents a catastrophic accident that could trigger a $10 million lawsuit and halt the job site for weeks.
That is incredibly powerful.
It is. Furthermore, the AI ingesting those 6.4 billion daily data points runs predictive maintenance models. T3 can alert the on-site mechanics that a specific hydraulic pump is vibrating outside of normal parameters and is going to fail 3 days before it actually breaks.
So it essentially transforms a dumb piece of steel into a smart network edge device. And the financial impact of this software on customer loyalty is staggering. The sources highlight a metric called the spend multiplier. Contractors who are highly engaged with the T3 platform, meaning they are actively using the software to manage their job sites, spend 6 times more on rental with equipment share than contractors who don't engage with the software.
6 times more. That is the holy grail of enterprise software. Stickiness.
It reminds me of the Apple ecosystem. Once you buy an iPhone and your contacts are in iCloud and your credit cards are in Apple Pay and you own an Apple Watch, the friction required to switch to an Android device is just too high. Equipment share is doing the exact same thing to general contractors. Once a project manager gets used to running their multi-billion-dollar job site with the digital visibility and control of T3, the friction of going back to the analog chaos of a legacy rental company is unthinkable. They are locked in.
And this leads us to the most ambitious paradigm-shifting part of equipment share's entire corporate strategy. They realize that T3 is such a powerful operating system, contractors want to use it to manage everything, not just the machines they happen to rent from equipment share.
Here's where it gets really interesting. So contractors want to put equipment share software on machines they own themselves.
Exactly. Right now, Equipment Share operates a standalone business-to-business software division where they simply sell T3 subscriptions to contractors to manage their own privately owned mixed fleets. Today, that standalone SaaS business generates about $30 million in annual recurring revenue.
And that is fascinating. Let's contextualize this. 40% of all construction equipment in the United States is owned directly by contractors, not rented. Equipment Share is taking their proprietary, highly addictive software and selling it to their customers to install on their own privately owned machines. And wait, they install it on machinery rented from competitors too.
Yes. A contractor can put a T3 tracking tag on a generator they rented from United Rentals just so it shows up in their centralized T3 dashboard. It is a brilliant Trojan horse strategy. Equipment Share is quietly ingesting the entire industry's operational data, regardless of who owns the physical metal.
And what is the ultimate goal for this software division?
Management has an explicit, stated goal to scale this into a $1 billion annual recurring revenue enterprise SaaS platform by 2030.
$1 billion in ARR. If we connect this back to the stock price and corporate valuation, this is exactly why the Wall Street bulls argue EQPT is fundamentally mispriced. A traditional industrial rental yard trades at a relatively low valuation multiple because it is a highly cyclical, capital-intensive business. But a company that generates $1 billion in recurring revenue from high-margin enterprise software, that deserves a massive tech multiple. They are quietly building a software stream that completely breaks the traditional industrial valuation framework.
It creates a bifurcated valuation model. You have a highly profitable 55% margin physical rental business paired with a rapidly scaling SaaS platform.
Okay, I love the SaaS narrative. It's a great tech story. But let's bring this back down to reality and look at the actual balance sheet, because software is relatively cheap to distribute, but heavy machinery is not. Equipment Share currently manages nearly $10 billion in physical equipment. The exact number from the Q2 deck is $9.85 billion in original equipment cost.
Yeah, that's a lot of metal.
Right. You can have the best software in the world,
Yeah.
but buying $10 billion worth of excavators requires a monumental amount of debt. If I am an analyst looking at their balance sheet, how on earth are they paying for all this metal without crushing themselves under a mountain of corporate debt?
That is the genius of their financial engineering. They aren't putting all that debt on their balance sheet. Out of that $9.85 billion in OEC, a massive portion is funded entirely off balance sheet via the ONIM-UN program. This is arguably the most complex yet brilliant part of their business model, and we need to spend some real time dissecting how it works.
Let's do it. To understand the innovation, we first need to understand the status quo. Compare the ONIM-UN program to the traditional on-balance sheet debt models used by the legacy players.
Right, so let's look at the giants. United Rentals has about $16.4 billion in trailing 12-month revenue, and Sunbelt Rentals has about $11.2 billion. Both of these legacy incumbents use a highly capital-intensive, 100% on-balance sheet corporate debt model.
Yeah.
So if United Rentals wants to buy $1 billion of new fleet, they go to the corporate bond market or a syndicate of banks, they borrow $1 billion, the debt sits entirely on their corporate balance sheet, and they buy the equipment.
And the risk there is that the interest payments are fixed, right? If a severe recession hits, construction halts, and that $1 billion of new equipment sits idle in a yard generating zero revenue, United Rentals still has to make those massive fixed interest payments to the bank every single month. It is a heavy, inflexible financial burden.
Exactly. It creates massive operational leverage, which is great in a boom, but fatal in a bust. Now, let's look at how Equipment Share bypasses that structural risk with the OWN program. Under this model, Equipment Share acts more like an asset manager or a fleet broker than a traditional owner.
Walk me through the exact mechanical life cycle of a single machine under this program. Let's say a $200,000 Caterpillar bulldozer.
First, Equipment Share leverages its massive scale to buy that bulldozer directly from original equipment manufacturers like Caterpillar, JLG, or John Deere at a steep bulk discount. But instead of putting that bulldozer on their own balance sheet, they immediately package it into a fleet portfolio and sell the physical ownership of the machine to one of over 1,300 third-party investors.
Hold on, so they are basically chopping up the ownership of physical construction equipment, the way Wall Street banks chop up mortgages, and selling the yield to institutional investors.
That is exactly what they are doing. They are securitizing the yield of heavy machinery.
Who exactly are these investors buying fleets of bulldozers? Are these just wealthy guys who like tractors?
It used to be mostly wealthy individuals in the early days, but the capital stack has matured significantly. As of 2026, the net OEC growth is funded 45% by institutional asset-backed securities, or ABS buyers. These are massive institutional funds. Another 29% is funded by large family offices, and 26% by high-net-worth individuals.
So a massive institutional asset manager buys the physical equipment. Then what? They don't know the first thing about renting out a bulldozer or fixing a blown hydraulic line. They must be handing the keys right back to Equipment Share to act as the property manager.
Precisely. Equipment Share enters into a long-term asset management agreement with the investor, usually spanning 6 to 7 years. Equipment Share maintains the equipment, deploys it to the mega projects using the T3 platform, collects the rental revenue from the contractor, and shares that revenue with the institutional investor.
Let's do the actual math on the economics here, because the Q2 transcript provided a really transparent look at this. Mark Wapata laid out the exact formula for the first half of 2026. Let's audit those transactions.
For the first half of 2026, Equipment Share received $728 million in upfront gross cash proceeds from selling equipment packages to these investors. Now, over the typical 7-year term of the management agreement, assuming historical utilization rates, Equipment Share expects to pay out approximately $649 million in net revenue share back to the owners.
Okay, keeping track.
And at the end of the 7 years, based on highly predictable industry appraisal curves, the equipment will have an estimated terminal residual value of about $338 million when they sell it on the used market.
Okay, let's run that through the calculator. You get $728 million up front to scale your network. You pay out $649 million over 7 years, accounting for the $338 million terminal value. When you run that through an internal rate of return calculation, what does the implied cost of capital actually come out to?
It translates to a highly competitive pre-tax cost of capital of approximately 7.0%.
7.0%, which, as we noted earlier, is virtually identical to what Equipment Share pays for its traditional corporate debt on the bond market. So they are getting the massive fleet scale they need at market rate pricing without taking on the corporate debt liability.
But the real magic isn't the 7% rate. If we connect this to the bigger picture, the real magic is the structure of the recourse. Think about your earlier point about a recession. What happens to equipment share in a severe macroeconomic downturn under the OWN program? Say, commercial construction halts completely, and that $200,000 bulldozer sits idle in a dirt lot for 6 months.
If they were using traditional debt, they would owe the bank interest every month regardless. But under OWN,
The payouts are 100% variable based on actual rental receipts. If a machine sits idle and generates zero rental revenue, equipment share pays out exactly $0 to the investor.
that is incredible. They have no minimum lease payments, no fixed debt obligations on that asset, and absolutely zero residual guarantees.
Zero. The institutional ABS buyers and family offices hold 100% of the asset collateral risk. If the value of a used bulldozer plummets in a recession, that loss is borne entirely by the investor, not equipment share. The OWN program acts as an automatic financial shock absorber for the company.
That completely shifts the downside risk off their books. But surely the investors demand a premium or some level of protection for taking on 100% of that risk. What happens if an investor gets cold feet halfway through the 7-year term and tries to pull their equipment out of the program?
They get hit with massive early cancellation penalties, ranging contractually from 12.5% to 50% of the original equipment cost. It economically locks the investor's capital in for the long haul, guaranteeing equipment share has the fleet scale necessary to service those mega projects.
Okay, I have to step back and ask the obvious question on behalf of the listener. If I am an institutional ABS fund manager or I run a multi-billion-dollar family office, why on earth would I agree to this? Why would I buy a fleet of used forklifts, take 100% of the downside utilization risk, accept zero financial guarantees from equipment share, and lock myself in with massive cancellation penalties? Are these investors just foolish?
Not at all. The investors are highly sophisticated, but they are optimizing for entirely different variables than a corporate balance sheet. First and foremost, they get the upfront tax depreciation benefits of owning physical heavy machinery.
Oh, of course. Taxes.
Right. Under tax codes like the Modified Accelerated Cost Recovery System, or MACRS, and bonus depreciation rules, high net worth individuals and family offices can rapidly write off the massive cost of that machinery against their other income, which is highly lucrative.
Ah, so they are buying massive tax shields.
Exactly. Second, the historical yield on these assets is very attractive in a normal construction environment, often outperforming traditional fixed income bonds. And third, they trust the asset risk entirely because of the T3 platform.
How does T3 help the investor?
Equipment Share gives every single OWN investor real-time dashboard access to track their specific asset. The investor can open an app on their phone and see exactly where their specific bulldozer is located, what its utilization rate was that week, and how much revenue it generated that day. The digital transparency fundamentally de-risks the investment from a visibility standpoint.
So it's the ultimate win-win structure. The investors get high yield and massive tax benefits with total digital transparency, and Equipment Share gets to scale a $10 billion fleet with zero recourse, off-balance sheet capital that automatically flexes with the macroeconomy. It's brilliant financial engineering.
It truly is.
But despite this incredible engine, heading into Q2, as we discussed earlier, investors were still spooked by the company's overall balance sheet liquidity and those related party governance issues, which leads us to how management aggressively cleaned house in the second quarter. Let's look at their capital allocation and how they built what the sources call a liquidity fortress.
In Q2, management clearly recognized they needed to permanently calm Wall Street's nerves regarding their cash position, so they built a fortress. Pro forma available liquidity was pushed to a massive $2.76 billion. They successfully reduced their net leverage down to 3.0 times adjusted core EBITDA, which management notes is well on the way to their long-term target of the low 2x range.
And a major component of that liquidity fortress was the debt refinance we mentioned earlier. They launched that senior secured note offering, and despite the skepticism about interest rates, they saw so much institutional demand, they upsized it to $1.35 billion at a 7.125% fixed rate. They used those proceeds to systematically pay down their riskier floating rate asset-based lending, or ABL, credit lines.
Yes. They used the fixed debt to retire the floating debt, and in doing so, they pushed their major corporate debt maturities all the way out to 2034. That provides an 8-year runway where they don't have to worry about a major refinancing cliff.
I understand the maturity extension, but let me push back on that 7.125% interest rate again. Explain the mechanics of why paying off floating rate ABL debt with fixed rate debt is a smart move, even if the fixed rate feels high right now.
It comes down to inflation and central bank risk. Asset-based lending usually floats, meaning the interest rate fluctuates based on the Federal Reserve's benchmark rates. If inflation spikes again and the Fed hikes rates to 8 or 9%, equipment shares interest expense on that ABL debt would skyrocket overnight, potentially crippling their cash flow.
So it's about predictability.
Exactly. By locking in a fixed-rate debt structure at 7.125% until 2034, equipment share essentially bought total immunity from any near-term credit crunches or central bank interest rate volatility. It might be a substantial carrying cost today, but in corporate finance, certainty always trumps marginal cost. It secures the capital required to fund their J-curve expansion without the existential dread of refinancing in a tight market.
It allows management to stop staring at the bond market and focus entirely on operational execution. And speaking of focusing on execution, let's talk about how they are returning capital to shareholders, because this was the most aggressive move of the quarter.
Oh, this was the ultimate mic drop on the Q2 earnings call. The board of directors officially authorized a $500 million Class A stock buyback program running through December 2028.
A $500 million buyback. For a company that Wall Street was just accusing of burning too much cash to survive, authorizing $500 million to buy their own stock is a massive middle finger to the short sellers.
Sure.
But mechanically, how can they afford a $500 million buyback if they were just burning $142 million in operating cash?
Because the cash burn was an aggressive choice, not a structural flaw. Remember the J-curve. They can pull the lever at any time to slow down the opening of new greenfield branches. If they freeze expansion, the $142 million burn evaporates, and the mature branches spinning off 55% margins generate a massive wall of free cash flow.
Oh, I see.
Authorizing the buyback signals immense insider confidence to the market. You simply do not authorize a $500 million buyback if your business model is fundamentally broken. You authorize it when you know your underlying cash conversion is incredibly strong and you mathematically believe your equity is severely undervalued by the public market.
It completely reframed the narrative from cash incinerator to disciplined capital allocator. And what about the final piece of the puzzle? The governance cleanup. The founder-related lawsuits regarding real estate.
CEO Jabuk Schlacks addressed it head-on during the call. He committed to a highly specific, concrete plan to wind down the related party transactions. The sources show that as of the end of Q2, less than $1 million of the entire $5.5 billion OWN program fleet remained tied to related parties. And regarding the real estate, the founder leases, which accounted for about $5 million paid year-to-date management, stated those are targeted to transition entirely off related party terms as they enter 2027.
So what does this all mean? If you step back and look at the whole Q2 picture, you have a $304 million revenue beat, a $1.35 billion debt extension locking in capital until 2034, a $500 million buyback authorization, and a complete scrub of the related party governance issues. It looks like a classic coming-of-age story. Equipment Share took all the messy, aggressive, complex parts of their founder-led startup phase and matured into a highly disciplined institutional-grade corporation in a single surgical quarter.
That is the perfect synthesis of the data. They de-risked the balance sheet, cleaned up the governance optics, and most importantly, proved via the bottom line that the greenfield unit economics are compounding exactly as they promised they would.
With the financials audited and the business model thoroughly dissected, let's pivot to the final verdict. What does Wall Street currently think about EQPT today, and what are the actual fundamental execution risks facing the company over the next few years? Let's start with the equity research consensus.
Wall Street is overwhelmingly bullish coming out of Q2. The current equity research consensus maintains a strong buy rating. We are looking at an 80% buy or overweight rating distribution, 20% hold, and absolutely zero sell ratings across the major banks.
Zero sells. That is incredibly rare for an industrial stock that was so highly volatile just months prior. Where are the price targets sitting?
The median 12-month price target sits around $37 per share. Given that the stock was trading in the low 20s around the August 2026 earnings release, that median target represents an approximate 80% upside.
Not bad at all.
No, but the range is quite wide, though, which reflects the varying methodologies analysts are using to value the software component. The most conservative bear case comes from Citigroup at $20, while the most aggressive bull case comes from Baird at $55.
That wide range from 20 to 55 perfectly illustrates the core debate on Wall Street. The bulls, like Baird, look at the T3 SaaS platform growing toward $1 billion in annual recurring revenue. They look at the capital-light, off-balance sheet OWN program, and they say, this is a technology disruptor that deserves a premium software multiple. The bears, like Citi and Wells Fargo, look at the exact same data, but they remain hung up on the high initial CapEx requirements of the J-curve, and they fear a broader machinery sector reset if the commercial construction cycle slows down.
Which brings us to the real execution risks, because an investment in EQPT is not without macro peril. First, if the macroeconomic environment sours significantly, that free cash flow drag from opening new branches could extend longer than the expected 24 months, delaying positive GAAP profitability.
Makes sense.
Second, you have real supply chain vulnerabilities. Equipment Share's model relies on buying massive volumes of equipment at a discount. If original equipment manufacturers like Caterpillar, JLG, or John Deere face sudden production delays due to material shortages, Equipment Share physically cannot absorb fleet fast enough to meet their mega project commitments, which damages their sole source reputation.
And the third major risk is tied directly to their biggest current tailwind, the hyperscale data center boom. We are seeing a rise in macro permitting moratoria across the country, situations where local governments or utility providers abruptly pause new data center builds due to power grid capacity concerns or environmental impact studies. If that massive, multi-trillion-dollar mega-project pipeline stalls due to local politics, Equipment Share could be left with excess fleet capacity sitting idle in specific regional markets.
Those are highly valid structural risks. But when you weigh those macro concerns against the company's internal structural advantages, my final verdict aligns with the bulls. EQPT is fundamentally mispriced by the broader market. It is currently trading at a traditional capital-intensive rental yard discount. But its structural DNA, the unique combination of the proprietary T3 SaaS engine and the off-balance sheet OWN capital model, makes it a category-defining infrastructure prime. They aren't just participating in the construction boom, they are fundamentally rewiring the logistics of how mega job sites operate.
If you take anything away from this deep dive, it's that sometimes the most disruptive, paradigm-shifting technology in the world isn't coming out of a sleek glass office in Silicon Valley. It's sitting on a muddy dirt lot, covered in yellow paint, actively transmitting billions of data points through the cloud to rewrite the economics of a trillion-dollar industry.
And here is a final provocative thought to leave you with, something that builds on everything we've discussed but looks a decade into the future. Consider the long-term trajectory of the OWN program. As it continues to scale heavily with massive institutional ABS buyers and multi-billion-dollar family offices, Equipment Share's balance sheet will become increasingly light. They might eventually look less like a traditional construction rental company and much more like an alternative asset management firm.
Oh, wow.
One that just happens to yield returns for its institutional investors via excavators and telehandlers instead of commercial real estate portfolios or private credit loans. What happens to the stock price when Wall Street finally wakes up and realizes they have been valuing a highly scalable, tech-enabled fintech platform as if it were just a local tractor rental yard?
A fintech platform yielding alternative returns via excavators. That completely changes the paradigm of what this company is. At the beginning of this deep dive, we talked about the tension between looking at a construction site and seeing dirty diesel machinery versus seeing a blunking digital server rack. The deeper you look into Equipment Share's T3 technology and their off-balance sheet financial engineering, the more that yellow iron simply fades away, and all you see is data, software, and highly optimized capital flowing in real time. Thank you for joining us on this deep dive. Keep questioning the surface narrative, keep digging into the numbers, and we'll see you next time.